Is Carvana stock a buy at current valuations? That's the question I'm going to look at in this video, looking at its revenue, its profits, its cash flow, and weighing them against the valuation to answer if the stock should be bought at current valuations. So let's jump right in, starting with revenue. And what you'll notice is two things here from Carvana's revenue over the last 6 or 7 years or so is a nicely trending upward growth line followed by the decrease in the recent year and a half. So the company was doing well, growing the business, expanding locations, reaching more customers. And during the pandemic, that even got accelerated the growth because supply chain shortages caused a decrease in production of new cars, and so people went looking for used cars, and so that created an increase in demand, increase in average selling price, and everything was working well for Carvana. And then they stepped forward a little bit too much into that trend. They started purchasing cars at higher and higher prices to resell at higher prices, but then the market kind of turned on them, where supply increased and demand for of new cars increased and demand for used cars decreased. Average selling prices fell, and the company was suddenly caught in a position where it bought used cars at higher average prices and it wasn't able to sell them at close to those prices. So it had to significantly tighten its belt, and now you've seen that playing out here, a big decrease in revenue down to 11.8 billion. The good news is maybe the recent auto strikes will cause a decrease in supply of new cars again, and that could be a boost for Carvana in the near term, enough so for it to right size its business to get on sound footing and then get back to growth. Overall, the company's business model, I think, is convenient for consumers. Nobody likes going to, well, I shouldn't say nobody, but very few people like going to a dealership, dealing with a salesman, negotiating for hours trying to buy that new car. Carvana's sales process is significantly more convenient, and that's evidenced by the phenomenal growth the company achieved over the several years before they experienced this recent downturn. The car sales process is ripe for disruption because of what I mentioned earlier. The process is not convenient for consumers, so consumers are looking for other options, and so Carvana is in the right place to capitalize on that trend longer term. So the next thing I wanted to look at is the company's operating income, and it briefly was turning in the right direction when sales were really booming during the pandemic, although it went downward significantly, reaching losses of near 1.6 billion. The cost-cutting measures are working so far. It's improved the losses, but it's still lost 820 million in operating income in the most recent trailing 12 months. That's more than double the rate it was losing money before the outbreak. So it's still not finished right-sizing the business, getting it back to firm footing. That's going to take more work and more time. The next thing I wanted to look at is the company's total long-term debt and cash on the balance sheet, because I know they went through these troubles during the overinvestment during the later stages of the pandemic. They had to borrow significant amounts of money, over $5 billion in fact, to steady itself and support itself while it right-sized the business. And so now it has long-term debt of $7.9 billion. If you compare that to the revenue of 11.8 billion, it doesn't look as massive because it generates more revenue than it has in long-term debt. Although, because the company probably had to borrow that money at higher interest rates than usual, because it borrowed the money during a situation that wasn't favorable to the company, so it was in a bit of a desperate situation, and whenever you're in that situation you got to pay higher interest costs, and so these long-term debts will now start to hurt the company's profitability because it now has to pay the interest income on these long-term debt. And so now I wanted to look at the cash flow from operations, and this has been working strongly in its favor. After dipping considerably in 2022, it's rebounding nicely. One of the ways it's rebuilding its cash flow from operations is reducing the amount of new inventory it's bringing in. I was going to say new used cars or cars that are new for Carvana in its lot, but they're used cars. And so by reducing the purchases of inventory, it's now just selling whatever cars it has on hand, and thereby it's getting rid of inventory and bringing cash in. And so it's increasing the cash flow from operations. But that can only go so far. It can only go so far in liquidating its inventory and reducing the inventory balance. That's not a sustainable way to boost your cash flow from operations. And finally, I wanted to look at the valuation. Carvana stock is up from its lows, but it's still trading at a forward price to sales of 0.441, which is higher than the levels it was trading at around July of 2022. So the valuation has increased. I think a little too much. I think the valuation got ahead of itself. The company has definitely made improvements to the business and made progress that is showing evidence of improvement. Although I think there needs to be more work to be done before I can say that the stock is a buy at these valuations. So at current valuations, I would say no, Carvana stock is not a buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.